My name is David Cornell. I'm the Managing Director of Ocean Dial Asset Management, which is the manager of the India Capital Growth Fund. And I'm joined by my colleague from Mumbai, Gaurav Narain, who's head of equities and responsible for managing this portfolio. And just very quickly on Ocean Dial, before we get into the nuts and bolts, we're a single country focused asset manager. We live and breathe Indian equities. That's all we do. We have a long-term track record of investing. Gaurav and I have worked together for 10 years plus on this product. We're FCA regulated. We're based in London, but all our research and all our analysis is done by Gaurav and his team of 5 analysts based out in Mumbai. To give you a little sense of the trust, we are closed-ended. Tom has spoken a little bit about that in the earlier presentation. We're very much mid and small cap focused, which is a key point of differentiation in our view from a lot of the other India-focused funds that are out there. We think the mid and small cap area of the market is the best place to find less well-researched, less well-understood, and therefore less well-priced equities. And we also feel that it's the kind of engine room of the domestic growth story when it comes to India. And the closed-ended nature of the trust works really well for us in that regard because, again, as Tom alluded to in the earlier presentation, we can take less liquid positions and take a much longer-term outlook, given the fact we're not having to manage the subscription and redemption process. So that flexibility gives us a natural advantage. We think the mid and small cap focus gives us a natural advantage. And if you want to just focus on one aspect of this light blue box in the top right-hand corner that highlights the fact that this trust has compounded around about 15% in sterling terms over the last 10 years. And that is taking into account all the currency depreciation we've seen in India, all the volatility that we've seen in the markets. And it's that 15% compound that we've achieved in the last 10 years we think we'll be able to continue to achieve going forwards. And that's what we want to talk about this evening. The portfolio is concentrated. It's 32 stocks. We have a very long-term outlook. Most of the stocks in the portfolio we hold for 5 years plus, and we're going to talk a little bit about that this evening. Now, the way we think we'll do it, the way we decided to do it, we'll do a sort of question and answer session whereby I'll shoot some questions to Gaurav in terms of his outlook on the market, his outlook on the economy, how he's positioned his portfolio. He'll answer those as best he can, and then we'll come back to you, Roland, at the end for any questions that might come from the audience. So with all that in mind, Gaurav, let's start by asking you what your outlook on the for the Indian economy is over the next 3 to 5 years or so.
Sure, David, thanks. To put it in perspective, this chart here is really telling you the size of the opportunity of the Indian economy. Today, the economy is about $2.7 trillion in size. About a decade back, in 2010, it was $1.7 trillion. But if you see the chart on the right, this is the IMF forecast for where India is likely to be in 2025. And that's somewhere close to $4.2 trillion, which effectively makes India the 5th largest economy globally. And it also implies that you're actually going to compound at 12% per annum over these next 4 years in nominal terms. Now, if you go by what the Indian government's own targets are, they're actually looking at the economy being about $5 trillion in this period. So really, there's a lot of focus on growth that is really built into what's happening in the economy. Now, even if you go to a slightly shorter time period, and that's over the next 2 years, in the next 2 years, in each of the next 2 years, India would be the fastest growing large economy in the world. So really, it's an economy which is primed for growth, and a lot of things have fallen in place to really drive, to have confidence that this growth will materialize.
So let's just Gaurav, highlight some of the key drivers of that growth that you're referring to.
Sure. See, what's really happened with India is that the last 4-5 years have been a period when the government has been carrying out a lot of reforms, largely to bring about transparency, and a lot of this has been driven through digitization. Now you're seeing the government have actually changed its stand, and really are really pushing for growth. So from the reform phase, it's really behind, and now it's really aggressive growth. And a lot of it is initially being led by the government through their own capex expenditure. For example, there's already a $1.4 trillion pipeline of infrastructure projects already lined up, and the government's leading the investments on that front. But I think the second aspect is also that the government again has brought in real recognition that the private sector has to really contribute in a big way on this investment as well. And to that extent, another change in thinking has been on, wealth creation, that, they're really encouraging wealth creation by individuals and the private sector. And a lot of the recent policy announcements have been to incentivize some of the efficient and large companies. For example, one of the big changes we are seeing globally today is the supply chain disruption. And India has really announced a lot of schemes to really capitalize on this, because after China, India is the large economy, and it's actually gaining a lot. So a lot of incentives just to ensure that the large, efficient Indian corporates are able to take advantage of that. So I would say that's one big change that's happened in this last year, where a really big push for growth. I think the second aspect of India, what brings us a lot of confidence, is the way the entire digital ecosystem has played out. And two things to bring in to notice. The one is, India is actually today the third largest startup economy in the world in terms of the number of startups there are. And it's really driving a huge amount of private equity and venture capital investments in the sector. All that is actually being, with these startups, it's really being spent in the economy, which is actually really giving a big demand push itself. But more importantly is the second aspect of this, that India is possibly the most advanced public digital infrastructure in place, and it's really driven by the government. So it's be it the payment side of the business, or identity cards, or KYC systems, or even the vaccination certification, and the way it's been played out. It's low cost, huge scale, and the entire private sector is leveraging on this. So it's really driving a lot of productivity enhancements which have happened. And the third aspect, and which is where India again differs from what's happening in the rest of the world, is that the last 4-5 years has been, because of the uncertainty due to reforms, most corporates have been focusing on the balance sheet. So there's a lot of deleveraging which has happened, and very strong corporate balance sheet sitting on cash. And so it's really primed to take advantage of the growth. A lot of consolidation has also happened. So the entire industry is primed. The moment you see growth, you'll see a lot of investments also kicking into the economy.
Okay, so just to summarize, the government has been focused on reform, which has been positive for the long-term structural growth of the economy, but has actually been disruptive in terms of profitability and growth in the implementation phase, and that's now over. And they're now pushing for growth, particularly post-COVID, supported by a pretty strong digital ecosystem, about which we're going to learn a lot more in the next 3-4 years, and a relatively unlevered corporate sector, which is looking to relever and start a new capex cycle. So what does that mean, Gaurav, for corporate profitability going forward, you say?
Yeah, actually what you see is, if you really see what's happening on the earnings, we've actually been quite surprised how the economy's played out in the last 3 odd quarters. Every quarter we've actually seen big earnings upgrades across corporate India. And this chart here really gives you how the earnings are playing out over the last 2 years and how it's playing out going forward. If you see the 2 bars on the left, that's how the earnings trajectory had been declining over financial year 19 and financial year 20. But ever since this growth push has happened, starting with COVID, the last financial year, which is year ending March 21, the earnings growth for the top 50 companies in India was at over 25%. And this is really going up to over 35% in the current financial year. And this is when you had a negative GDP, you had a huge amount of disruption due to COVID. Even if you look at our own portfolio of companies, we have 32 companies, and the aggregate earnings growth for our portfolio of companies is over 30% in each of the next 2 years. This is the highest we've ever seen. Now, there are reasons behind this. One is, of course, that there is a slight lower base because of the slowdown we've witnessed in the last few years. But there's also a lot of consolidation which has happened, a lot of digitization which has happened, which is actually giving the organized, efficient companies a lot of runway for growth. So it's really across sectors, parameters, we are seeing very high growth playing out.
Okay. And then how does that translate to your portfolio?
So actually, we've done a lot of, COVID has provided a lot of opportunities because of the volatility in the markets. And I would say in the last year and a half, we've really revamped our portfolio to take advantage of some very strong structural businesses at very attractive valuations. And they're really playing out on some of the themes, which are the themes of the future. To give you a perspective, one big story which is playing out is how the Indian economy is moving to a gas-based economy, where entire industries are moving to gas from the more polluting fuels, where all cities are moving to a city gas distribution business. So we've got a company called Gujarat Gas, which is the largest city gas company, and it's also one of the largest suppliers of industrial gas. Again, a structural, very long-term growth story. We have a big theme that's playing out today is the de-risking out of China, which is happening. India is very strong in the chemical space, and that's where a lot of shift has already happened and will continue. And we've got a company called Aarti Industries, which is actually already winning 5- and 10-year contracts with companies in Europe and the US. So, again, you're actually seeing visibility of growth happening over the next five years as well. Even in areas like electric vehicles, we have a company called Sona BLW Precision. It's into very high engineered precision forgings like differential gear assemblies, etc. Now you'll be surprised. It supplies to 100% of Tesla's differential gear assemblies. It's a very critical component for the China facility. I would say it's possibly the only Indian company which is meeting 100% of requirements of a factory in China. That's the sort of nature of companies we are being able to build our position in. Here again, they're winning orders upon orders from electric vehicles across Europe and US. So, the sort of order book is building up for the next 5 to 7 years. So it's a very strong, sustainable, high growth, long-term trajectory businesses which we've got into. And we really intend to hold on to these for the next 3 to 5 years.
So just to stress, I mean, the turnover in the portfolio is actually pretty low over the 10 years that you've managed it. But the opportunity that COVID gave us when the markets collapsed in March and April last year was the chance to refresh it with some of these quality names. But let's look at the portfolio in a bit more detail or in aggregate and just talk us through the overall exposure.
Sure. Actually, if you look at the chart on the left, that really gives a breakdown by sector. And I would say it's a fairly balanced portfolio. What we do have I would structure it into two halves. One is what I would call economy-linked plays. And this we are really playing largely through our financials, through cement companies, and more recently through some consumer discretionary companies, be it brown goods, be it auto ancillaries, where we've taken almost 44% of our portfolio. I would say the balance is what I'd call our steady long-term compounders, which are really consumer businesses, some of these pharmaceuticals, specialty chemicals, and a lot of individual niche businesses, which are market leaders in their own right. So it's really, I would say, a mix where even today, I would say 50% of my portfolio I've held for over 5 years. And that's really giving you the conviction and the growth of the earnings side of it. On the earnings side, as I mentioned earlier, that we are possibly seeing the best growth phase we've seen in our portfolio. We're actually looking at earnings growth of 30% plus in each of the next 2 years. This is the highest we've ever seen. Typically, our portfolio would have an earnings growth of anywhere between 18 to 20%. And even if you see valuations, we're trading somewhere closer to 17 times on FY23 earnings, which is slightly below the market. But more importantly, in the previous peak cycle of 2017, we were trading at that time at about 21 times. So I would say it's a fairly balanced portfolio with reasonable valuations and very high growth.
And just, I mean, you've got big exposure to the consumer, you've got big exposure to financials. Financials is one sector that's been under the cosh for the last 3-4 years, you could say. We had a banking crisis in India in 2018, 2019, and then in the COVID-driven economic uncertainty, there's been issues around poor quality loans and uncertainty about repayments. And how confident are you in that big exposure to the financial space?
Okay, so on the financial side, I would say that's the best play on the economic recovery story that we are expecting to play out. But I think you should look at financials from two aspects. One is in India, you had a big cleanup due to the regulatory changes and new bankruptcy code coming out in 2016. And that led to a big NPA crisis in India. Now that phase is actually behind, as books have all been cleaned up, provisioning has been made, capital has been raised. So in fact, when you look at what's happened now with COVID coming in the last 2 years, there's been no large corporate default in the Indian economy. Where the stress lies is largely in the small and mid enterprises, and these are not large ticket loans. So that's one side of it. The second aspect is that the Indian banks, at least the banks we own, have provided adequate coverage. In fact, in the banking system, the provision coverage ratio is over 70%. So really, they've already projected a hit and have upfronted the provisioning. And the third is last year, most of these banks raised a lot of capital, and they've actually not had the opportunity to utilize it because the NPAs have really not arisen. So this is all growth capital sitting in their books. So really, it's all about the demand revival happening. Today, what you're seeing is on the retail side, despite COVID and the disruption you've seen, retail credit growth is still growing at very strong double digits. What was not growing was the large corporates, which had actually been delevering and focusing on working capital constraints, etc. But that phase also we now expect to start taking off, as a lot of companies have started announcing capex plans.
Okay. And Gaurav, just quickly, are there sectors that you won't invest in? Are there areas of the economy that the portfolio will never see exposure to?
I think we are very, there are certain sectors which, for ESG reasons, we will clearly not touch. So it's not in our universe. These include tobacco, defense. We also don't invest in businesses which we find difficult to understand, which are very complex in nature or are very global facing and B2C businesses. So you're taking calls on what's happening in China or the US markets. And even commodities, pure commodities like metals, because we find that, sitting in India, you're just a taker of information and don't have that information edge. So I would say those we stay off it. The second aspect we stay off is wherever we find even an iota of issue on corporate governance, we try and stay out of those businesses. Other than that, I think we are open to everything. But what we do is we create what is called a universe, whereby we do very intensive research on about 145 companies, which is what we feel we can manage, where we have very detailed models and earnings, etc. But all these 145 companies would be quality businesses with very strong fundamentals. So you're really playing a call on the valuation side rather than the nature of the business. So you're very clear that you'll buy structurally sound, strong businesses.
Okay.
Especially where you have an edge and are not an information taker.
Okay, so a limited pool of stocks to invest in of around 140, 145, which have been pre-screened for quality governance issues. I want to just address the elephant in the room now, which is valuations. I mean, India is not a cheap market at the best of times. It's had an extremely good run in the last 12 months or so. And these charts here would suggest the market is quite expensive relative to history. Is this the right time to be investing in India, do you think?
Yeah, actually, if you look at these charts, what is emerging is clear that, if you both the small cap or mid cap index, which is the chart on the right, and the top 30 stocks, which is the Sensex, which is chart on the left, is actually trading well above the historical mean valuations. Having said that, one should also realize that where you're getting surprised is on the earnings side, and that will be the big driver going forward. Now, how we look at the valuations is really we'll go really into our own portfolio of companies and also on our whole universe of 145 companies, where for each company we have what we believe is a fair value and what should be the target price based on that. Now, there what we find is that it's really a mixed bag. Uh, where valuations are clearly well above the historical averages are businesses which have fairly predictive growth and it's a fairly long-term predictive growth. These are consumer chemicals and businesses which the trajectory is fairly steady, and you can see that. And there, the valuations have really jumped up almost 50% above their mean. But in sectors wherever you're seeing a bit of uncertainty, like financials, etc., the valuations are well below the historical averages. So it's, as I mentioned, it's a mixed bag, and you've got to really take a portfolio approach to that. And why some of our stocks we do have high valuation stocks, but there we are so certain about the on the growth side that you're basically playing out for a bit of the time value for it. If things correct, or you may have a period of 6 to 12 months where nothing happens, but over time they'll give you that compounding story.
Okay, so the benefit of the portfolio approach is that you're able to select stocks based on a better understanding rather than looking at the market in aggregate and making a broader assumption. I think that's what you're generally saying.
And to really get back to your first slide where you highlighted the 15% compounding growth the portfolio has delivered, it's largely because we really focus on the earnings side, and the portfolio is delivering that 15 to 18% earnings growth. Then over time, your portfolio will also deliver that sort of compounding growth.
Okay. Okay, now listen, I want to ask you about the risks. We know about known risks. We don't know about unknown risks, but what are the ones that you know about that you're worrying about?
So, I'm not too worried about the fundamentals of the Indian economy, because I would say that on most macro factors, India is much better positioned than it has historically been in the previous cycles. So I would say that's not an area of concern. I think the two concerns we have, the first is really on COVID. If there is a third wave, our big story is that the economy is recovering. It's taken off well after the second wave, and the outlook and all signs point to a very strong growth sustainable growth going in the future. But if you have a third big wave of COVID, this growth again gets pushed back by a year, and that given that the valuations are moving up or markets have moved up, that could be slightly disruptive and shift everything by a year. The second worry is really not in our control, is really global liquidity, and if interest rates rise in the US, you may have money flow out of emerging markets, and by default India would also be affected by that. Having said that, my sense is it's going to be more of a short-term temporary disruption, because the fundamentals of the economy is fairly strong, so that itself should offset it over time. Plus India, the nature of the economy has changed, and there's a lot of domestic liquid money going into stock markets now. So there is a big balancing factor also coming up on that side.
Okay. So a few domestic risks, a few global risks to consider. So I think in terms of timing, I just want to wrap up now and highlight a few points by way of conclusion. I think we feel very strongly that after a period of disappointing growth, India is set to perform much better. We think Indian businesses are winning market share in the global marketplace, particularly away from China. The domestic economy is recovering, and the private sector is going to reinvest after 3 or 4 years, and that's supported by productivity arising from improvements in digital and tech. And we feel very strongly that mid and small cap is the best place to take advantage of this cyclical recovery, and that the investment trust, the closed-ended structure, is the right structure to manage that recovery. I think most importantly, from our perspective, that global investors remain structurally very underweight India by comparison to China, or by comparison to India's contribution to global GDP growth, which is around 15 to 16%. The global contribution or commitment to India from an equity perspective is way below that.